Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about this thing that's going on in Canada where debt seems to be on the rise, inflation seems to be on the rise, but mostly we're just going to talk about debt and why you should probably stop. Not financial advice, but probably stop investing as aggressively as some people may be, because they kind of go like, blindsided or just one way and never, you know, look at the other factors that come into investing. So we will talk about the Canadian consumer debt, and why maybe it might be a good idea to slow down, maybe not stop, but I guess slow down the investing frequency or the investing amount when it comes to your investments, because of how much consumer debt you may have, and may be feeling the weight of currently in the economic situation that this whole world is in. So if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So before I get into this whole thing, we'll go through the portfolio, but I just want full disclosure. This is not financial advice. I just want to talk about the amount of debt that has increased over this past year, and what, in my opinion, is perspective for maybe a lot of people, because it's not talked about, I don't think, enough. We always hear the negative when it comes to this stuff. I mean, you can find any piece of validation on why you're struggling or maybe not struggling, even in these times, right? You'll find the answers that you're looking for, if you are looking for them. Okay. So portfolio this week, not this week, but today, closed out at $13,414.54, down $36.87 on the day, down 0.27%. For the 1 week, we're down $490.27, down 3.52%. For the 1 month, down $692.88, down 4.91%. For the 3 months, down $194.65, down 1.43%. And for the 1 year, $424.79, down 3.07%. Finally, over 1 year, we are finally down. It looks like the data is just catching up now. And since starting this portfolio, we are only up $544.82, up 4.23%. We got $8.46 in the cash account. And every position here you can see is down except for a few, which are TELUS, Loblaws, and Qualcomm. Everything else down. Okay. So what are we talking about today again? Oh yeah. Canadian consumer debt, not including, including mortgages as well, but that's a different thing. I think mortgage debt can sometimes be good debt, as they call it. Now, by most people, they maybe not most, but some people don't consider debt being good at all. I don't even know what I was saying there. Mortgage debt, who cares about it? Let's just talk about debt. Okay. Canadian consumer debt has risen. I read this on an article, $2.32 trillion. The amount of millions that are in $1 trillion is 100 million millions. Okay. 100 million millions are in $1 trillion. And there's 38 million Canadians, all spread across Canada. 100 million millions. 100 million millions are in $1 trillion. That means everybody can be like a multi-millionaire. That's how much Canadian consumer debt has risen over the past year. The average debt load for every Canadian is about $21,000 if you just spread all the debt across evenly. And that represents an 8.2% increase since last year. So what does that mean? It means that more and more people are taking on debt in times of high inflation, huge inflation hikes to combat the inflation, of course. Bank of Canada is doing their best to kind of slow down the inflation and tighten things up, and are no longer flooding money into the market, because we are no longer in the years 2020 when the whole thing happened, and And lucky for some, everyone got these benefit payments. CERB, I didn't. At the time, I was working throughout the whole thing. Fortunately, now I understand that some Canadians or most Canadians were not fortunate enough to do that. So I'm not here to boast or anything. But now we're in a place where we need to tighten our ships up. Okay, financially, investing is great, but if it makes sense for a lot of people, I get it. It's our futures. If you invest, you got the spare cash to do it. But if you're in debt, it makes it a bit harder. I know more and more Canadians are relying on credit card debt or lines of credits, or taking, money out of their home equity lines of credits just to make ends meet. With the way that inflation is happening, the way that interest rates are going up, and cost of living is just going up. I get it. I understand. I'm not here to say that I'm better than everybody else or I'm in a better position. I'm just here to say that maybe slowing down on the investments might be a good idea to tackle any high interest debt. And I'm talking about credit cards, because credit cards are your biggest culprit when it comes to this stuff. It's very easy to take this plastic card that has 20% interest rate typically and use it to make ends meet when you're in a financial bind at the end of the month or at the end of every paycheck or whatever it may be. And so I get it. But we're all in this kind of like in this place where, we're all feeling the effects of interest rate hikes, inflation. We're all feeling the same effects. Okay. Some of us may own a home, some of us may not. The people I'm more concerned about is the credit card people, because that debt will continue to rise if you don't pay it off in full each month. It doesn't make sense for an investment that may make a 20% return, or sorry, not a 20%, an investment that on average does a 10% return per year on average. That's not the median, the average rate of return. I'm talking about the S&P 500 index ETF, low cost with Vanguard, which we do have in here, by the way. That it's better to invest in this than to pay off your credit card debt. I don't believe that's true. If a credit card debt is sitting at an interest rate of 20%, and let's say best case scenario, the Vanguard S&P 500 gives you 10%, you are still behind 10%. Simple math, you take 20% of the credit card, right? 20% minus the 10% return that you got from your investment, and you are still behind 10%. Hello? Does that make sense? So if the reason why you're investing is because the market is down and not paying off debt because the market's down because you want to use your capital to invest in money, I don't think that's the smartest decision. And again, this is just my opinion and perspective. So tackle your debt, slow down on the investments. I'm pretty sure, now I'm not certain, it's never a guarantee. In my opinion, I still think we have a lot of downturn in the stock market, as we've seen in the past week, and the current week, and throughout this whole year. It's just been a bumpy ride. Why put yourself through that stress and not tackle what is inherently causing you more financial pain, which is your debt, credit card debt, consumer debt, any car loans, anything of the sort, right? Now, also remember, anybody who's in a mortgage, interest rates have quite heavily gone up, and 2 million, roughly about 2 million Canadians in the next 12 months will feel the interest rate hike when they are renewing their mortgage. Okay, I read that in the article as well, which is absolutely crazy. The information I got was online, and of course, it's not from Reddit or not from a forum. Facts. Okay, so 2 million Canadians will renew their mortgage this year, and they will feel ultimately the pain of, the price tag of the interest rate going up, maybe double from what they are used to, or even sometimes in some cases triple. The interest rate these days are like 5.4% on a 5-year fixed term, and at some point I'm pretty sure they are like 1.9. Some are even at lower than that, and they will feel the effects probably in the next 12 months. Canadians already struggle with making their mortgage payments Canadians already struggle with just making ends meet. So if you have debt, I would really reconsider what your financial strategy is when it comes to investing and when it comes to paying off your debts. You want to be in a position where kind of both plays out, where you have very minimal debt where you can handle and you can invest when markets are doing what they're doing now. The greatest thing is that when you're in that kind of a position, you've given yourself the advantage of being prepared for anything to happen, for opportunity. The problem with having debt and investing heavily is that eventually the debt's going to catch up to you, in my opinion, and you'll end up selling your investments because you're forced to pay off any debt that you have, and all that time that it was used to accumulate capital appreciation, dividends, and things like that will be wiped out, because essentially you're not supposed to touch your investments, just reinvest and continue to do that in order to build a solid foundation for your portfolio. Now, I don't know if that's something you wanted to do or you plan to do. Plan to invest so that you can pay off a bunch of debt down the road. I'd rather, in my opinion, in my scenario, have literally no debt, have the investment stay and do what it needs to do, incubate, so that it creates a big enough capital appreciation where market downturns don't affect it, that dividends stay above the amount of decline that's happening in the market, and have literally no debt. Okay. That's probably the best position you can probably be in. And a lot of people are probably feeling that now and thinking about, oh, I wish I didn't have debt now. Well, today is the day you can start making those little changes, not big changes, but small tweaks that can adjust your debt ratios, so that the next time that this happens, you're in a position of strength. You're in a position of, I can now invest as much capital as I possibly can and flood the market with my capital to get it to work for me, instead of me working to pay off a credit card that is really useless, in my opinion, other than paying for plane tickets, hotels. That's pretty much it. Credit card debt is bad, in my opinion. At a 20% interest rate, if there was a 20% return on investment somewhere, I'm sure every Canadian, every person in this world would attempt to put their money in there. Yet we're okay. Some people are okay. I'm not okay. Some people are okay with paying 20% for money that's not even theirs. Mind blowing to me. I get it though. Financial hardship. It's a good emergency. It's quick. It's easy. It's painless. No friction when it comes to using that piece of plastic that says Visa or MasterCard. Love those companies, but dang, is there a fine line that you can cross where you are financially ruined because of a credit card, or you're financially just set? Okay. So other than that, guys, just a little rant. Have a great week, or try to. The markets don't look like they're doing any better than they were last week. Kind of just stagnant, losing small dollars over time. Not to be a downer or anything, but maybe reconsider a lot of things. Take into consideration what I said. Of course, it's not financial advice. It's just perspective, in my opinion. So I have the right to an opinion, and you have the right to comment. So don't forget to leave a like and subscribe, and we'll definitely see you guys in the next one. I definitely don't know what to do with my hands other than move them together. So other than that, guys, have a great week. Bye.